To understand why mortgage rates are as high as they are, first you have to understand how mortgage rates are set. So, how are mortgage rates set? 30-year fixed-rate mortgages are loosely tied to something called the 10-year Treasury bond yield. This yield is the amount of money that you will get back in interest if you were to invest into a government 10-year Treasury bond. Lots of banks who issue mortgages also invest into government bonds. So, how do they affect mortgage rates? Well, if you're a bank and you can invest into a 10-year Treasury bond and get an almost guaranteed 4% yield on that investment, why would you give money to a person who needs a mortgage at a 3% rate? It doesn't make sense financially. This is why 30-year fixed-rate mortgages are typically higher than the 10-year Treasury bond. The difference between the 30-year fixed-rate mortgage and a 10-year Treasury bond is something called a spread. An average spread between the two since the Great Recession is 1.7%, or 170 basis points. However, right now, we're closer to 300 basis points. At the time of this recording, the 10-year Treasury bond yield is currently 4.28%, and the 30-year fixed-rate mortgage is 7.09%. The spread between these two can widen for a variety of different reasons, most of them having to do with something called a mortgage backed security. A mortgage backed security is a pool of thousands of mortgages put together into a single investment. This helps eliminate risk for the investor because there are so many mortgages in this one investment. When mortgage-backed securities are threatened due to economic uncertainty, this is when that spread usually widens. Mortgage-backed securities can be threatened with prepayment risk, duration risk, and credit risk. Prepayment risk is when these mortgages are getting paid off earlier. This happens when people refinance or they sell their home and buy a new one. When one of these mortgages are prepaid, the mortgage is closed and then that mortgage is then taken from that mortgage-backed security pool. Credit risk has to do with the risk of defaulting on that mortgage. The riskier the borrower, the higher the interest rate, but also the higher risk of defaulting on that mortgage. Finally, duration risk. Now, duration risk is essentially how long it's going to take someone to pay off their mortgage. When interest rates on the 30-year fixed rate are higher, this typically increases the duration because most people aren't refinancing or selling their home because the interest rate that they already have locked in is much lower than the interest rate they could get now if they were to buy a new home or refinance. The spread is also affected by the federal funds rate. As the Federal Reserve increases the rate of the federal funds rate, this also widens the spread between the Treasury yield and the mortgage rates. The Federal Reserve has been increasing its federal funds rate for several quarters in a row now, and people aren't sure when the Federal Reserve is going to stop these increases or reverse them and start lowering the federal funds rate again. Most experts believe that when the Federal Reserve pauses its federal funds rate increases or starts to reverse and lower the federal funds rate again, this is going to have an effect on that spread. So for example, with today's 10-year Treasury bond yield at 4.28%, with an average spread of 170 basis points, this would put mortgage rates at 5.98%, which is drastically lower than the 7.09% they are at now. When the Federal Reserve finally pauses its federal funds rate increases or starts to lower the federal funds rate, this is going to tighten the spread. It's also going to lower the yield on the 10-year Treasury. So it's going to have a double effect on mortgage rates. The spread is going to tighten and the yield is also going to come down. So that's when I suspect mortgage rates are going to normalize. If you're still waiting to buy your first home, it's better to prepare now. There's hundreds of thousands of future homeowners still waiting for those mortgage rates to normalize. Most of them have been priced out of the market due to today's mortgage rates. If you need help preparing, you can always reach out to a trusted real estate agent, and they can tell you what you need to do now to get ready for when the time finally comes.